The line at the grocery store barely moves. Across town, in a glass office tower, an economist watches a different screen. A single number flashes, 6.8%, the annual inflation rate. It is just a statistic in abstraction, a data point. Yet that number is quietly reshaping millions of lives in real time. How does a percentage on a government report translate into smaller grocery bags, postponed vacations, and shrinking savings? Why does inflation, often described as a general rise in prices, feel like a targeted tax on the middle class? It is the story of how inflation moves through the financial system like a hidden current, lifting some assets higher while pulling purchasing power downward. Modern central banking emerges in the 20th century with a specific mission: prevent economic collapse. After the Great Depression, policymakers conclude that falling prices deflation can paralyze an economy. If people expect prices to fall, they stop spending. Businesses stop investing. Unemployment rises. To avoid this spiral, central banks such as the Federal Reserve adopt a target: modest, steady inflation, often around 2%. The logic is straightforward. A little inflation encourages spending and investment. It reduces the real burden of debt over time. If you owe $100,000 today and wages and prices rise gradually, that debt becomes easier to carry. Inflation is meant to lubricate the machine. But here lies the paradox. The tool designed to stabilize the economy slowly redistributes wealth within it. To understand how, we must walk through the plumbing. Imagine the economy as a network of pipes. At the center is the central bank. When it lowers interest rates or expands the money supply, new liquidity flows into the system. This liquidity does not fall evenly from the sky. It enters through financial institutions, banks, bond markets, asset managers. Step 1. Cheap credit. When rates fall, borrowing becomes inexpensive. Corporations refinance debt. Investors leverage portfolios. Mortgage rates drop, fueling housing demand. Step 2. Asset appreciation. With more money chasing the same number of asset stocks, real estate, bonds prices rise. The S&P 500 climbs. Home values increase. The balance sheets swell. Step 3. Consumer transmission. For households that own appreciating assets, inflation can be partially offset. A homeowner sees their property value increase. An investor watches their equity portfolio expand. But the middle class often sits in an uncomfortable middle. They may own a home, but also carry a mortgage. They may have retirement savings, but most of their wealth is concentrated in wages, and wages adjust slowly. This is the hidden flaw. Inflation moves faster than income. According to numerous Bureau of Labor Statistics reports, periods of elevated inflation often see real wages adjusted for inflation decline before they recover. Prices change weekly, salaries change annually. The catalyst arrives when inflation accelerates beyond expectations. In the early 2020s, pandemic stimulus injects trillions of dollars into the global economy. Supply chains fracture. Demand rebounds sharply. The inflation rate surges to levels not seen in 4 decades. Now the chain reaction begins. Rising prices erode purchasing power. Central banks respond by raising interest rates aggressively. Mortgage rates double. Monthly payments for new homebuyers spike. Credit card interest climbs above 20%. The middle class, already squeezed by higher grocery and fuel costs, now faces higher borrowing costs as well. The same mechanism that once inflated asset prices now works in reverse. Housing transactions slow. Stock markets correct. Yet essential expenses, rent, insurance, healthcare, remain elevated. Inflation reveals its asymmetry. They repay loans with cheaper dollars. Those entering the market late face higher costs on both goods and credit. The middle class becomes the shock absorber too asset-light to fully benefit from rising markets. This pattern is not confined to consumer prices. It echoes in modern financial headlines. Private equity leverages cheap credit during low-rate periods. Cryptocurrency markets surge during liquidity expansions and contract during tightening cycles. The blueprint is identical. Liquidity enters, assets inflate, leverage builds, and when policy reverses, pressure concentrates on those least insulated. So how should one analyze inflation going forward? First, track real wages, not nominal wages. A 5% raise during 6% inflation is a pay cut. Second, watch interest rate policy alongside inflation data. The response to inflation can be as impactful as inflation itself. Third, examine asset ownership. Inflation often widens wealth gaps because assets typically adjust faster than wages. Finally, understand the time lag. Inflation is not a single event. It is a process. The effects ripple outward in stages. Return to the father at the grocery store. His budget is tighter not because of a single price increase, but because the architecture of the financial system channels inflation unevenly. The economist's 6.8% is not abstract. It is embedded in rent contracts, loan agreements, and salary negotiations. Inflation is neither purely destructive nor inherently beneficial. It is a force engineered, managed, and sometimes misjudged. And its impact depends on where you stand within the system. Understanding inflation is not about predicting the next spike in consumer prices. It is about recognizing how money moves, how policy decisions cascade, and how purchasing power quietly shifts hands. Inflation does not shout, it compounds. And for the middle class, the difference between stability and strain often lies in how well they understand the machinery shaping the numbers on that screen.